You watch the market drop for the third day in a row. Your stomach tightens. You open your portfolio app again, even though you checked it an hour ago. The number is red. It keeps getting redder. You start thinking about selling, just to be safe, just until things calm down. But here's what almost nobody tells you. The people with $1 million or more invested were never going to make that decision today. They made it months, sometimes years, before the drop even started. This isn't a story about timing the market. It's a story about what happens long before the timing even matters. Let's start with a number that should bother you. DALBAR, a research firm that has tracked investor behavior since 1994, publishes something called the quantitative analysis of investor behavior every year. It compares what the stock market actually returns to what the average investor actually earns. And the gap is brutal. Over the last 30 years, the S&P 500 has returned close to 10% annually. The average equity fund investor earned several percentage points less. Not because they picked bad stocks. Because of when they bought and when they sold. They bought after the market had already gone up, when everyone felt confident. And they sold after it had already gone down, when everyone felt scared. Buy high, sell low, the exact opposite of the plan. Repeated on average by millions of people, year after year. So why does this keep happening? A psychologist named Kahneman, working with Amos Tversky, spent decades studying exactly this. Their research, which later won Kahneman a Nobel Prize in economics, found something called loss aversion. Losing money hurts roughly twice as much, psychologically, as gaining the same amount feels good. So when your account drops 10%, the pain isn't proportional, it's amplified. And amplified pain pushes people toward one action: make it stop. Sell. This is where the wealthy investor's story actually begins. Not during the crash. Before it, picture two people. Both have worked hard. Both have done well. One has 90% of their net worth, sitting in a handful of tech stocks. Because that's what's been going up. And going up feels like proof you're doing it right. The other has a portfolio spread across stocks, bonds, real estate, and a cash reserve that could cover a year or more of expenses without touching a single investment. The market drops 15%. The first person watches their net worth fall by almost the same amount, and every bill, every expense, now has to come out of a shrinking, panicking pile of stock. The second person's portfolio drops too, because almost everything drops in a real downturn. But it drops by 6 or 7% instead of 15%. Their bonds barely moved. Their cash reserve didn't move at all. And that cash reserve means they don't have to sell anything, at any price, to pay next month's mortgage. That difference isn't luck. It's a structure that was built before the storm arrived. Ray Dalio, who built Bridgewater Associates into one of the largest hedge funds in the world, has written extensively about exactly this kind of structure. He calls one version of it the all-weather approach. A portfolio deliberately built to survive economic environments nobody can predict in advance. Growth, recession, inflation, deflation. Dalio's argument isn't that you can guess which one is coming. It's that you shouldn't need to. If your portfolio is built correctly, the specific season barely matters. That's the first thing wealthy investors do differently. They stop trying to predict the downturn and start building something that doesn't require the prediction to be right. The second thing is even less exciting, and that's exactly why most people skip it. They hold cash. Not because cash is a great investment. It isn't. Inflation quietly erodes it every year. They hold it because cash is optionality. When the market crashes and prices are suddenly on sale, the investor with cash on hand can buy. The investor who is fully invested, or worse, in debt, can only watch or sell. Warren Buffett has said this in almost exactly these words for decades. Be fearful when others are greedy, and greedy when others are fearful. It sounds like a clever quote. It's actually an operating instruction. Berkshire Hathaway has, at various points, sat on tens of billions of dollars in cash, specifically, so that when a downturn creates panic-driven bargains, Buffett has the ammunition to buy them. That cash pile looks lazy in a bull market. It looks like genius in a crash. The wealthy investor accepts looking lazy for years, on purpose, to have that option when it matters. Here's the counterintuitive part. Most people think the rich get richer during downturns because they have some secret information, some early warning system the rest of us don't get. They don't. Institutional investors, hedge fund managers, even Federal Reserve economists routinely admit they cannot reliably predict when a downturn will start or how deep it will go. Robert Shiller, the Yale economist who won a Nobel Prize, partly for his work on market volatility, and wrote the book Irrational Exuberance, warning about bubbles years before they popped, has said plainly that timing these things precisely is nearly impossible, even for people who study it for a living. The wealthy don't outpredict the crash. They outprepare for it. That's the twist. It isn't a smarter forecast. It's a boring, unglamorous structure. Diversification, cash reserves, low debt, built during the calm, so that the panic, when it arrives, doesn't force a decision. There's a second layer to this that rarely gets mentioned. Research from finance. Professors Brad Barber and Terence O'Dean, using data from tens of thousands of brokerage accounts, found that investors who trade the most frequently earn significantly lower returns than those who trade the least. The most active traders in their study underperformed the market by several percentage points a year, largely because trading itself, especially reactive, emotional trading, is expensive and usually poorly timed. Wealthy investors, or at least the ones who stay wealthy, tend to trade less, not more, during a downturn. Their big decisions were already made. A crash isn't a call to action. It's a test of a plan that was written down before anyone was scared. Look at what actually happened in 2008. The S&P 500 fell nearly 57% from its peak to its bottom over about a year and a half. Investors who sold near the bottom, which a huge number of retail investors did, according to fund flow data from that period, locked in the loss permanently. Investors who held on, or who had cash to buy more shares while everyone else was dumping them, recovered fully within a few years, and then kept compounding for the next decade. The market itself didn't care who was scared and who wasn't. It only rewarded whoever was still holding shares, or buying more, when the recovery started. That's not a story about courage. It's a story about whether your finances were structured, before 2008 even began, so that you didn't have to sell. Now bring this back to your own account. You don't need $1 million to use any of this. The structure matters more than the size of the number. An emergency fund that covers 3 to 6 months of expenses, sitting somewhere boring and liquid, does for you exactly what Buffett's cash pile does for Berkshire Hathaway, just at a different scale. It gives you the ability to not sell when everyone else is selling. A portfolio that isn't entirely concentrated in whatever has performed best recently does for you what Dalio's all-weather thinking does for Bridgewater. It means one bad season doesn't wreck the whole plan. And simply trading less, checking the account less, reacting less, letting a long-term plan run without constant intervention, does for you what Barber and O'Dean's research suggests. Separates the people who compound wealth quietly, over decades, from the people who trade themselves into smaller and smaller numbers. There's one more piece worth mentioning, because it's the least glamorous of all. Rebalancing. Once or twice a year, wealthy investors, and the advisors who manage their money, sell a little of whatever has gone up the most. and add it to whatever has lagged behind, bringing the portfolio back to its original targets. It sounds almost too simple to matter, but it forces a kind of discipline most people never practice on their own. Selling a bit of the winner while it's still winning, buying a bit of the loser while it's still unpopular. It's the mechanical version of buy low, sell high, done on a schedule instead of on emotion. No prediction required. Just a calendar and a rule you agreed to follow before the market gave you a reason to break it. None of this requires predicting the next crash. Nobody can do that reliably, not the wealthiest investor in the world, not the sharpest economist on television. What it requires is deciding, on a calm day, what you'll do on a bad one. Building the cash reserve before you need it, spreading the risk before it's tested. Writing the plan before the emotion shows up to argue against it. So go back to that moment. The market's down 3 days straight. Your stomach is tight. You're staring at a red number, thinking about hitting sell. The question was never whether you'll feel that fear. Everyone does, including the people with $1 million in the market. The question is whether you built something beforehand strong enough to survive the decision fear wants you to make.